Sorry. Let's see. Okay. Test. All right, great. Okay, so I promised I will recap a little bit from last week where we left off on the final lecture on exchange rate determination. So we talked about managed exchange rates, the pros and cons, and we specifically talk about deviations away from UIP, which is basically our always our baseline assumption when talking about financial or economic models. We assume there's perfect markets, right? But when we want to be realistic, we augmented the UIP last week using this rho symbol to capture this additional risk premium for holding on to bank deposits domestically, right? In other words, the way to interpret the rho is that it's supposed to compensate for holding on to domestic bank deposits, given the existence of relatively more likelihood of higher default risk or bankruptcy risk. You can think of it either way. And so therefore, in that sense, it matters whether or not you use, when you conduct monetary policy, whether or not you buy or sell domestic or foreign assets. So let me explain to you, let me recap again why it matters to buy, whether you conduct monetary policy using foreign or domestic assets. So suppose there's what's called imperfect asset substitutability, and which means that it matters, and I'll show you why it matters. So suppose that the Fed decides to conduct expansionary monetary policy, and as I said, there's two ways to do it. Method one involves creating money supply through purchasing domestic assets. So imagine you're the chairman of the Federal Reserve and you're conducting open market operations. You want to expand the balance sheet. You want to create more liquid money supply. And you would typically do this using buying US Treasuries, for example. So here, that's one method, right? You can expand the balance sheet by just intervening into the bond market, secondary bond markets, and you buy up US Treasuries. The other way to do it is rather than buy US assets, you turn around and you create money to buy foreign currency. In this case, suppose you buy Chinese yuan, and you use that Chinese yuan to buy Chinese assets. In which case, there's no change in R star and MS star because you're just buying and then selling the currency, but you have changed the composition of the Fed's balance sheet. Right now, if you decide to buy domestic bonds, buy foreign assets, you're expanding the balance sheet. However, the proportion of foreign assets now has expanded, right? The relative proportion of foreign assets has expanded on your balance sheet. So in the end, you do still get the increase in money supply right through here, but rather than expanding the asset side using BCB, right, domestic bonds, you're expanding via WCB, right? You're expanding the foreign composition proportion of your balance sheet instead of expanding the domestic assets. All right, so why does it matter? It matters because we expanded the UIP equation now with this rho term, and we know this rho is positively related with the amount of domestic assets being held privately. The idea is the following: if you have more assets being held privately among households and institutions and banks, etc., then there's more assets or cash flows you need to service or interest payments you need to service, and there's this higher likelihood that you might go bankrupt, default. So think about debt overhang. The idea that's that idea. You have lots of creditors, and you have to pay off your creditors, and it's not sure that you'll be able to service that. So in which case, we can decompose this private holdings of domestic bonds into two parts. There's total bond issuance. BTOT stands for total bond issuance, and BCB stands for domestic bonds held by the central bank, hence the CB. And if a central bank decides to expand the balance sheet, money creation, by increasing domestic bond purchases, it's going to increase this variable here. If you increase this variable, this minus sign becomes more negative than before. And actually, this entire term inside here becomes less, in which case rho actually decreases. And if you work through the mathematics, if rho is lower then the inequality becomes this way, right? In which case E needs to move in a direction to offset this change in rho. And so that means that E is going to decrease. So this actually works against you, right? You want E to increase. But if you decide to intervene by expanding the balance sheet through domestic asset purchases, you're going to get an opposing force here, right? Assuming there's imperfect asset substitutability. So in circumstances in which you have, again, imperfect substitutes, meaning that the credit worthiness of your domestic country versus the credit worthiness of your foreign country, they're not comparable, in which case rho is going to be non-zero. If rho is non-zero, then it matters whether or not you intervene in monetary policy using domestic or foreign assets. So here with imperfect asset substitutability, you should not intervene with the change in BCB, because doing so will create conflicting effects on the nominal exchange rate. Okay, so this is a demonstration again that buying foreign assets avoids this issue. So all else, I mean, if the problem doesn't state imperfect asset substitutability on your exam, you can safely assume you have perfect substitutes between foreign and domestic assets. It's only when I mention this should this be taken into consideration. Okay. All right. So we talked also about sterilization. So sterilization is important because some countries want to leave their money supply unchanged. And if you combine sterilization with this idea of imperfect substitutes, that means you can change E without changing MS, right? Because if you sterilize, that just means you change the composition of your balance sheet, but you haven't expanded or decreased your balance sheet, right? If you decide to sterilize. So if you expand through, so in this case, if I'm going to sterilize intervention in favor of foreign currency, it means I'm going to sell domestic assets, in which case I'm decreasing central bank holdings, which means I'm going to decrease money supply. I'm going to create domestic currency in the second step. So this cancels out with this, and then use that extra money to buy foreign currency, and then use that foreign currency to buy foreign assets. So in the end, all the MSs cancel out. All you have change is a decrease in BCB and the increase in WCB. So money supply doesn't change all around, but the composition of your balance sheet has. And with this change combined with this augmentation of the UIP, you can effect a change in E. Okay. So no inflation, right? Because money supply hasn't changed. In this class, we just assume that inflation is a purely monetary effect, right? So no inflation, yet we get a change in E, right? Depending on which direction you go. So this is in favor of foreign currency because we're buying foreign currency, which strengthens the foreign currency. So you can think of the opposite, sterilization in favor of the domestic currency, then that means you're increasing BCB and decreasing WCB. All right, so again, takeaways the following. If there's imperfect asset substitution, then UIP risk premium increases since more private holdings of domestic debt. So sterilization combined with augmentation of UIP with this additional risk premium connects is the argument for why emerging economies tend to sterilize their FX intervention. Okay. All right, so we talked about pros and cons. I'll let you read this yourself. I talked about fiscal policy under fixed exchange rate. And then, I listed out the mechanism here so you can read it yourself. But the basic idea is if you decide to conduct fiscal policy, you're going to have an output effect, but there's a secondary effect, right? You're going to have a crowding out effect coming from changes in E in the direction that makes the currency stronger if you're expanding fiscal policy, and the reverse, right? If you're contracting fiscal policy. But in doing so, if you decide to maintain a fixed exchange rate, you have to also, in conjunction, conduct monetary policy to support the fixed E, right? So in this example I give you, we're conducting fiscal policy expansion, which means government spending increase or decrease in taxes, which means output increases, but the secondary effect is that the domestic currency gets stronger. That's going to crowd out, right? It's going to crowd out your output effect. So to maintain the E, however, because this is not possible under fixed exchange rate regime, you have to conduct monetary expansion. With increase in MS, you get an increase in E, which will allow you to maintain the E, and so no crowding out of stimulus by the current account. Okay. Devaluation through stimulation to devaluation. So this is just like monetary expansion under flexible exchange rates, right? The difference here is that there's no, in both the short run equilibrium and the long run equilibrium, we are just assuming that the central bank adjusts itself such that the E always stays constant, no matter which equilibria we are in. Things are enhanced if you have this rho term, right? Because if you decide to conduct devaluation, if you decide to conduct devaluation, rho will actually help you if you actually buy foreign assets as opposed to domestic assets, if we have imperfect asset substitutability. And revaluation the other way around, right? So the rho can help you if you have imperfect asset substitutability under devaluation or revaluation scenarios. And lastly, the last thing I talked about was escaping the zero lower bound situation. So most countries, I believe, as far as I know, central banks try to escape the zero lower bound by going negative interest rates. But primarily, this is trying to disincentivize banks from putting their money in the reserves. Okay, so if you charge negative interest rates on reserves, banks have incentive to move them out and lend them to investors or businesses. That's the idea. For consumer side, I don't think there was a case in which consumers actually paid negative interest rates. Again, the idea is that people will want to move their money out and put it into bank vaults, right? Or something that doesn't chip away at their currency. All right, in any case, an alternative solution to the zero lower bound problem is devaluation. And when you have devaluation, you have interest rates that are set to zero, in which case you have an exchange rate that's basically stuck unless you have some way to change E hat E, and you can. You can tell the world or all your international trading partners that you're going to devalue your currency at some higher, weaker level, right? Higher level of E hat E, which will allow you to escape, in which you get a new value for E, and may allow you to recover your ability to shift the A schedule, right? As we saw for that graph from last week. So I won't show you that, but that's the idea. You devalue the currency because there's no way to cut interest rates anymore, right? So you devalue your currency and hope that that may allow you to recover your ability to conduct monetary policy once again, in which case maybe you can, maybe you can't. Okay, So that's the takeaway from last week. So let me move on to this week if no other outstanding questions. So this week, so yeah, so one last thing, I need to do problem set number 6 solutions. Okay, so which is the last thing regarding to exchange rate determination. Today we're going to start a new topic on swaps, and I believe you guys already have some background. So today will be mostly review. I will review bond valuation because I'm going to interpret swaps from the perspective of a portfolio of bonds, and I'll get into that later. Okay, so that's my agenda. So problem set 6, some background on bonds, and just in case you forgot from last semester, and I'll move on to swaps. So problem set 6 is a question where I describe to you the observed outcomes of what happens in the markets, and you're supposed to come up with a way to explain it with the model that we have at hand. So let me read the question just in case you don't have it in front of you. So this is the kind of question that I'm very likely will ask you on the exam. So just a hint. So the macroeconomic non-intervention. So take the perspective of the South Korean resident. In particular, let E denote the price of dollars in terms of Korean won. And you observe the following simultaneous macroeconomic developments. So suppose you observe that Korean output falls, and you observe an appreciation of the Korean won, and a fall in the Korean current account. So all these things have to be true. And our job is to find a way to explain what happened to arrive at the following things that we observe. Okay. And then the final part of the question asks you, how can the Korean government combat this negative output effect to restore your original starting point? So let's go ahead and analyze this. So there's really, let me see what it asks you to do. So two possible scenarios: a negative shock to consumer tastes or a positive shock to money demand. So let's do case one. So case one is a negative shock to consumer taste for South Korean goods. So suppose the consumption function has changed such that for any level of income, you will always have lower consumption amounts. So if you look at aggregate demand equation, that just means that, right, if lower C for any level of income, that means lower demand, which means Keynesian cross, blah, blah, output must decrease. And so DD schedule must shift to the left for any level of E. So if you were to draw a graph, that's very simple, right? DD curve shifts to the left. In which case we should observe that E has increased, output has increased for sure, but E has increased, right? So this description does not match here, right? This is what we observe. We observe lower Y, lower E, and lower CA, but we observe higher E, right? So which is not consistent with case one. So we can easily dismiss this scenario. Case two is a positive shock to money demand. So let's go ahead and analyze that. If we look at the money market equilibrium with lower positive money demand shock, you can think of that as just the L function has become more sensitive to anything, every parameter, I guess. So here we assume that MS now is lower than L, P times L, right? And we have to think about what has to move. Well, based on this, it appears that we have to find some way to decrease L prime now. So decrease L prime only if interest rates go up, right? So that means that interest rates go up, which means that E has to go down, right? So which is consistent with this, right? Which means that the AA schedule is actually shifting down, right? So we do indeed get an output effect, right, going in this direction. And also our E is going in the right direction as well, this way. So indeed, this matches with this. And also, if you think about CA, CA is a function of Q, and lower Q means lower CA, right? And so everything is consistent. So case 2 is definitely the most likely scenario given those two options. Right, fairly simple. All right, so to combat this effect, we kind of know what's going on. So the obvious solution is to just simply conduct expansionary monetary policy, right? This will allow you to shift the A schedule back up and you'll restore equilibrium, the original equilibrium. Right? Very, very simple. All right. Comments, questions on this kind of reverse engineering things that are going on in the financial markets using the model? Then you can make a diagnosis using monetary fiscal policies to restore back to your original equilibrium. Right? That's the idea. All right. Number 2, the adjusted uncovered interest rate condition can be expressed as the following. We know this. It's just the risk premium now as a function of privately held domestic bonds, right? And now we want to show Federal Reserve increases aggregate money supply permanently. And they're going to purchase domestic bonds in the open market. So use a diagram, compare your answer to question 1 of homework 4. Okay. So homework 4 was about different intensity of the shift of different curves. Okay. So let me show you the solutions here. Okay. So we're talking about a permanent increase in money supply. It's increase, right? Yes. And it's going to be done through BCB. And we know what's going to happen. Increasing BCB is going to make this entire expression lower, which is going to make rho lower, which means that the inequality is going to go this direction, which means E has to respond in such a fashion that elevates this entire right-hand side, and that's only possible through lower E, right? However, people will expect this, right? Because it's permanent. People will expect this. So in fact, I'm doing it right? Yeah, okay. Yes. So E, so that's the rho. People will expect a permanent increase in MS, which means that E hat E will increase, right? And what we're basically saying here, to make any sort of conclusions, we have to make some sort of assumption about how large the changes of E hat E is relative to the rho effect, right? So if people believe that overall the effect of the permanent monetary policy expansion is going to have a large effect, then that's almost saying that this change in rho may be negligible, right? So that means the change in rho, absolute value, very, very low, less than the change in expectations. So if that's true, then we already know what's going to happen, right? The analysis is quite trivial. It's the same thing as you would find when you conduct monetary policy, permanent monetary policy without the rho term, right? You have this overshooting followed by a reversion, etc. So the point of this question is to think about this scenario, right? So laying this out allows you to draw certain conclusions. If this is violated, then something else happens, right? Then you don't get the overshooting, right? You may get undershooting or a reversal in the other direction, right? So that's something you have to think about. All right, so let me recap again. 2 things that happen. Number 1, you have this term here, which has a negative impact on E because lower rho will violate UIP in such a way, which requires E to decrease. However, a permanent monetary expansion will have an effect on E hat E in a positive direction, which means that, right, E wants to go this way. So the question is the impact on the change of E hat E is going to impact E in a large enough way to crowd out the opposite change in rho. And so if you make that assumption, then the analysis for short run and long run analysis, short run, long run analysis looks the same as week 6, right? 7/8. Otherwise, you get some degree of undershooting, right? Otherwise, undershooting, because E goes the other way, right? So look at previous homework, right? As we did this analysis before, right? Depending on the curves shifts, if one curve is shifting large enough, that may give you an opposite prediction. If in this case, if we have the expectation changing in a larger magnitude than the change in rho, then you're just going to get the same analysis. Otherwise, you get something like undershooting. And I believe we did something like this with the change in L, right? The change in L. So here's the same idea. We're looking at the change in rho versus the change in EHI as opposed to change in L. Okay, comments, questions on number 2 of problem set 6. All right, so I think this is very likely to show up on the final exam. I'll go over sample questions, of course, in the last week. And this may be something, I'm gonna think, this may be too open-ended for an exam question, but again, this is just forces you to think about conflicting effects. And it depends, right? And an open-ended question would ask you to outline the assumptions necessary to draw certain conclusions. Alrighty, so today's lecture is very much review. So I'm afraid that I might I mean, the way that my slides has been structured is so that it's self-contained. So if you don't have any background in if you don't have any background, if you don't have, hold on, find my lecture here. Oh, I guess I forgot to remove that slide. Sorry. Let me do that now. That's why I'm confused. Okay. All right. Sorry about that. Okay. So as I said, if you do not have any background in bonds, I will review it very quickly. So this is my condensed review of bonds. So bear with me for the next hour or so as I try to get through bond valuation using my notation and so forth. Okay. So why are we concerned with bond valuation? Well, the way swaps are designed, there's really 2 ways to think about swaps. So swaps, you kind of know what it means based on the names. You're literally swapping something, one thing for another. And so there's really 2 ways to think of it in terms of financial instruments. You can think of it as a portfolio of forward contracts, right? We learned about forward contracts. I mean, you should have learned forward contracts. We learned about forward contracts in week 4, week 5. Somebody has to deliver something and you pay something, right? So there is an exchange. There's an inflow of cash flow, there's an outflow of cash flow. But the problem with swaps is that usually it doesn't go out beyond more than like 5 years. If you look at the contracts available for forward or futures contracts for currencies or even interest rates, it doesn't go out that far. And what that means is that swaps typically are OTC, meaning that you have to find a counterparty willing to engage in a long-term contract to exchange certain cash flows. So the best way to think about this is certainly through a portfolio of bonds, meaning that you have to design a portfolio such that you receive some cash flows because you're going long on a certain bond, and then we create an outflow by shorting a bond, right? When you short a bond, it means you issue a bond, right? It's like you're issuing a bond, you have to service the interest payments, and so there's cash going out based on some interest rate that you determine at the time of contract. And likewise, if you're long a bond, you lend somebody money, right? But there's going to be a constant stream of cash, periodic, right? Periodic stream of cash, and that creates an exchange. If the timing of the interest payments are, they're precisely timed at the same time, right? So if you go long and you go short, and the bond pays out, let's say interest payments once a year, then once a year you will receive you will have an exchange, an inflow of cash and an outflow of cash, right? Make sense? So to recap, two ways to think about swaps. One is through a portfolio of forward contracts. You certainly can value swaps if they only go out for 5 years. You can probably find those quotes online somewhere, and you can price it that way, right? You just sum the value of the forward futures contracts, and that's the value it should be, today. On the other hand, if you want a swap contract that goes out perhaps 10 to 20 years, you can imagine yourself as a corporate finance guy for a company. You want to start sales in a certain country for the next 10 to 20 years, and you want to mitigate exchange rate risk, right? Or even interest rate risk. So to do that, it would be hard to find a counterparty through forward contracts because they don't go out that far. What you would need to do most likely is you need to design a swap between using bonds, for example, right? Okay, so that's how we're going to price swaps in this class. And just to give you a overview of why valuing swaps is very different from valuing stocks, is because debt contracts are priced based on their exposure to interest rates. Okay, and interest rates are more like macro risk as opposed to firm specific risk. The reason, again, because we're talking about risk-free interest rates as opposed to bond yields, corporate bond yields. So in that sense, you have to worry about things like inflation risk, right? Or systemic risk, across different countries or globally, those kind of things, like macro factors that can affect many clusters of countries or companies at a time. So that's why inflation becomes important, because you need to understand monetary policy over the long run. You may need to think about the trade-off between borrowing in the short term and borrowing in the long term. And so there may be what's called a term premium between different maturities of bonds. You may also have to think about how liquid certain maturities of bonds are. That may determine the return you get on the bond. Okay, so lots and lots of other different types of things to think about in comparison to stocks, right? All right, so let's go ahead and dive quickly into bond valuation. Bonds that pay riskless cash flows or payments are priced using what's called the term structure of interest rates. Okay, so this is the instrument interest. These are the interest rates that you get, the interest return that you get for holding onto risk-free assets like sovereign debt, like government issued debt. We'll talk about that later, but the ideas here is sovereign debts have fixed income, meaning it's fixed coupon payments. And based on those coupon payments, you can derive an average return, which is called the yield to maturity, right? Average return meaning you hold on to the bond all the way to 10 years, and what's the average return you would get based on the interest payments and based on the principal that you get at the end. Okay, once you have that idea of what a bond is, or sovereign debt is, you can derive the proper discount rate for risk-free rate based on the yield to maturity, right? Based on the average return for holding on to these bonds. and you use these average yields to discount risk-free cash flows, therefore, right? So if you have cash flows, for example, here, C1, C2, so this is 1 year into the future, 2 years into the future, all the way to T capital years into the future, you would discount the cash flows by the appropriate interest rate for the length of time that you have to hold for the risk-free bond and earn an average return of, for example, R1 or R2 all the way to RT, okay? So these returns are annualized, so that's why there's a squared and a T and so forth. So the R's that you derive from here, R1 to RT, will give you what's called the yield curve or the term structure. So this is just the cross-section of interest rates at any point in time, right? So I guess people may be confused when they see something like this. Let's say this is a percent yield, right? This is the yield, and then you have maturity, YTD. Let's just say some YTM, yield to maturity. You may see a curve that's like this, right? So each point on the curve, you can think of it for now just as the average yield to the yield to maturity for a specific bond that matures, for example, in 1 year or 5 years, etc. Okay, so you might be thinking in your head, are there always bonds being traded on the market or being issued that's exactly 1 year or 2 years to maturity? And the answer is, of course not. They're not issuing debt every day. Okay, the auctions occur at depending on the Treasury, or in this case, the Ministry of Finance. They have a schedule, and that's when. And it doesn't happen every day. Okay, so the way economists deal with this is they interpolate the points. But for master students and MBA students, etc., we're just going to draw straight lines to connect the dots. All right, so this will be on your case study. I'll ask you to do that. All right, so just know that in reality, there are very complicated and sophisticated models that interpolates the lines between the yield to maturity for every bond that's being traded. Okay, and this is based on investor beliefs about future growth path. There's based on surveys about inflation expectations, blah, 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 a bunch of inputs, and it will spit out, an interpolated line that connects the dots between all the points. That's all you need to know. Okay, and using this term structure, you can therefore discount any cash flow, risk-free cash flow from any time out. So if it's 5 years out, back to time zero to get the fair price for that cash flow. Okay, so remember, this is for risk-free cash flow, so no risk. All right, so we know what a term structure is, right? So let's give you an example of how it changes. So here is an example of the financial crisis term structure. So as you can see from November 2006, our typical upward sloping term structure has already been violated. It's downward sloping. And hopefully based on your previous class, you kind of have an intuition that maybe downward sloping is a reflection of people's expectations about future growth. If that's true, then this downward sloping yield curve suggests that people believe that in the very short term, their returns, average growth of an economy looks like it's gonna be, the growth rate in the future. So if it's today going out perhaps 2 or 4 years, it's gonna be lower than today, right? So you can think of it as that. So what happened during the financial crisis? Here we already see an indication of a financial crisis. People believe something bad is going to happen. And then we had the collapse of those banks, Lehman Brothers collapse, blah, blah, blah. And people started buying treasuries. So based on our understanding of buying stuff, buying assets will increase prices, and increased prices will decrease bond yields, right? Which explains the dramatic downward shift of the entire yield curve, right? So much so that it seems to be somewhat skewed, right? Why is it skewed 0 to 8 years? Because these are the maturities that are the most liquid, okay? So as you can see, there's a change in liquidity demand, right? There's also a change in people's beliefs about future growth rate, right? So we're gonna be screwed in the short term, but then somehow we'll get ourselves out of it sometime in the future. And also there is a flight to safety, right? People are moving away from mortgage-backed securities, away from equities because there's bank collapse, etc., and moving into safer assets like U.S. Treasuries. And if you tracked gold prices during this time, gold also spiked. Right? So there's lots and lots of factors impacting interest rates here. So this is the numbers I gathered for these 3 years: November 26, so 2006, 2007, and 2008. And we're just going to go through very quick exercises to use these numbers to price bonds. Okay, so suppose we have a security of the following cash flow: 50, 50, 50, and $1,000,000 in 50s. So let's say 1,050. So of course they're probably in millions, but let's just use small numbers. So I asked you to price the security if we are in 2006, and then price the security if we are in 2008. The way to do this, of course, is to use the term structure depending on where you are, right? So if we are in November 2006, we will use the November 2006 term structure to price each of these cash flows 1 year out, 2 year out, 3 years out, and 4 years out. So this is obviously a bond that pays $50 every year and a final principal payment of 1,000, right? Plus the last coupon payment. So using this term structure for 1 year, 2 years, 3 years, and 4 years, we can price this cash flow, get a fair value of that cash flow today. So that's what I did. I'm gonna breeze through this because I don't want to spend too much time on this. Okay. So assuming annualized interest rates and coupon payments occur every year, then it's just the following. It's just the interest rate, and then we square it because it's 2 years out, 3 years out, 4 years out, discounted back to times 0, you get this number. For 2008, there's only 2 periods left, so we just use the 2008 term structure. So that's here. So notice that the numbers are super, super tiny, right? It's like 0.91%. So, yep, 0.91% and so forth. And you should get a value of this. Okay. So that's why you use the term structure. Cool. All right. The shape of the term structure has changed a lot, as you expect. Maybe during the pandemic, you kind of already lots of mention of that in the news. So the shape of the term structure has been a good predictor of recessions. So here, the red bars indicate inverted yield curve. So that just means if you take the difference between the yield to maturity of, for example, 10 years minus 5 years, as you imagine, the 10 years minus 5 years under normal circumstances in which the country expands economically, the 10-year yield minus the 5-year yield will typically be positive. But when it inverts, the yield to maturity of the 10-year will be lower than the 5-year, and therefore you get a negative number, right? So the red parts are when the yield difference between 10 and 5 years are negative. Okay. The gray bars are recessions, as deemed by the NBER. Okay, this is NBER recession bars. So if you look at the red lines and the gray bars, the red lines look like they precede recessions, right? So it's a reasonable first simple indicator for recessions. So here, so this is the inflation era. This is the dot-com bubble, right? This is the dot-com bubble. This is the financial crisis, right? And I think we saw something like that. I'm not sure if we saw something like that before the pandemic, but you can verify yourself using the data. Cool. So now we know what a bond is. It's fixed income. There's intermittent, equidistant interest payments every year, every 6 months, whatever, it doesn't matter. And there's a final principal payment, like a loan, right? The initial loan that you get, you have to pay it back. And because we're talking about risk-free assets, these cash flows are discounted based on the term structure of interest rates. So to give you an idea of how large the bond market is. So examples of bonds, government bonds. So how large is the market and why are we using bonds to price derivatives? Well, because it's so liquid. So US Treasuries as of 2022 is 145% of US GDP. So this is the USA, okay? For US Treasuries, 145% of its value. Its value is 145% of its GDP. So, which means that US is borrowing a lot lately. In fact, I think just before the pandemic, it was less than 100%, which was actually surprised me a little bit. But now it's ballooned into 145%. So they have as you imagine, a somewhat of a debt crisis. We don't know how long it's sustainable. Japan, um, believe it or not, is even worse than US. It's 261% of its GDP. China, on the other hand, has shrunk a little bit recently. It is 77%. And Germany is 66% of GDP. This is all proportion to GDP or economic growth, economic output. All right, very, very sovereign debt, very, very liquid markets. But other examples of bonds, corporate bonds, of course, Apple has recently become very leveraged. They were very low actually, but now their leverage is, oh, sorry, miswrote this. This is 124. It doesn't matter, but 124. Apple's 145. Yeah. So this is a percentage of equity. Okay. And Tencent has actually remained quite stable in terms of their capital structure at 45% of their market cap. So equity. Okay. And lastly, mortgages, another very common debt that's been traded. So we care about China and Hong Kong. So China is about 63%. And Hong Kong is about 93% of GDP. Okay. Of GDP. And to give you some perspective, this is not as bad as you think. So Switzerland is a 128% of GDP. So Swiss people take out very, very large household debt to buy houses in comparison to China and Hong Kong. Right? Anyways, the point is debt is everywhere. Debt connects us all. Currencies should be viewed. In this class, you should think of currencies as some form of credit, therefore debt. And so naturally, we should think of swaps also in terms of debt. Okay. So as I said, coupon bonds or bonds in general usually have coupons, meaning that they have periodic interest payments. That's why we have this term coupon rate. That just means that the coupon rate percent is multiplied by the principal, and that multiplication value is what's paid out in the contract every period. So here we have how do you determine the coupon rate? It's the face value of the contract. So this is the loan that you borrow multiplied by the coupon rate. And if the payments occur, for example, semi-annual, then you divide by 2. And that's how you determine the coupon payments. So here we have CCCC all the way to maturity plus the face value of the debt, right? So I use these terms interchangeably. So principal is the same thing as par value, is the same thing as face value, right? They all mean the same thing. Or initial loan, right? Same, they all mean the same thing. Cool. So far review, everything's just review. Bond yields. So how do you get the bond yields? Well, if you know the price and you know the coupon payments and you know the face value, you can back out the bond yield. You can solve it with a computer. So we're not going to do it by hand. All right, so the bond yield is simply the interest rate that satisfies this equation, right? price is equal to C discounted by that Y plus F discounted by Y, all the way, depending on where the cash flows are, T to capital T. And you just solve for the Y, right? That satisfy this equation. So let's see. Suppose two bonds have the same maturity but have different coupon rates. Are the yields the same? And the answer is obviously no, right? Because the C is different, right? If you have different C's, different R's. I mean, different Y's, sorry, different Y's. So you get the price, you get the proper price with the term structure of interest rates. That just make that clear, right? So if you want to price cash flows, you use the term structure of interest rates. But if you want to get an average return for the bond, which is called yield to maturity, then you're just solving for that single Y for this equation here. So that's the difference. I hope everybody is makes sense, right? Nothing, it's obvious, yes? Cool. All right, so maybe a simple exercise. Let's compute the yield of a 3-year bond with face value of $100. So we know the principal, right? It's $100. There's a coupon rate of 10%, and it's annual, so you're just dividing by 1. And it's currently priced at $103.83. So you can use Excel, but yeah, you should use Excel. So how do you set up the question? Well, as I said, we know the price. We know the coupon payments is 10% of 100. And the final coupon payment is 10 plus the principal. So it's 110. We are solving for Y, which is an annualized average yield that gives you this, that allows us to get this equality on left hand, right hand side. So if you use trial by error, or if you use the IRR formula, you should get this 8.5%. Right. Let's move on. So if you haven't noticed, bonds are different from stocks because they're typically quoted in yields instead of prices. And so we can compute prices with different inputs too, right? So if you know the yield, and you know the face value, and you know the coupon payments, then you can calculate the cash flows, and then you can now calculate the price, right? So here we know it's going to be $8 every period because it's 8% on $100. So we know the cash flow, we know the final principal plus the final coupon payment. We know the average return, which is 9.25. That should give us the price, right? So to recap, if you know the yield, you know the coupon payments, you know the par value, you can get the price. If you know the price and if you know the coupon payments, then you can know the yield. You can back out the yield yourself, right? So I forgot the 100 here, so I apologize. It's a 100 plus. Cool. All right. So I'm going to highlight the nomenclature or naming conventions of government securities for the US. So I don't know, Chinese bonds may have different terminology, but I'm just tell you US. So US have 3 types of sovereign debt categories. One is called treasury bills or T-bills. They are issued with maturities 3, 6, and 12. They are typically zero coupon. So zero coupon means that there's only one final bullet payment, in which case the yield to maturity is therefore just the discount rate, right? It's sometimes called the discount rate. Treasury notes are couponed. The coupons occur every 6 months, and they can range from 2 to 10 years. And treasury bonds go out to 10 to perhaps 30. I don't know if there's any more. And again, coupons are every 6 months. So you will see these naming convention often in the Wall Street Journal, etc. Okay, so to price treasuries, if we have, again, we have the term structure of interest rates, we use those rates, but because interest rates are annualized, we have to do some compounding frequency conversion. So if we are given the term structure of interest rates in the following manner, so suppose you have, okay, so suppose you have these rates already, then it's fine. But otherwise, you would have to back them out through a way I have to show you later. Okay. Let me see. Okay. So for semi-annual coupon payments, make sure that you're discounting appropriately in terms of annualized numbers, right? So for half a year is 0.5, again, because these numbers are annualized. And for R1, it's just to the first power. For 1.5 is to 1.5 power, etc. Okay. And okay, so let's do an example. What is the current price of a treasury note with 2 years to maturity, a coupon rate of 8%, and that's semi-annual, paid out semi-annually with a face value of $100. So because it's semi-annual, we divide the coupon rate, which is annualized, by 2, which gives us 4%. And so we know that the coupon payments is $4 every year for 4 years. And we're going to discount based on these annualized numbers, but they're taken to the half power, to the 1 power, to 1/2, etc. Everything's annualized in annual terms, I mean. So that's how you get the price for a treasury bond. Okay, semi-annual payments. All right, so that's pricing your typical bond. That's semi-annual coupons. For different types of coupon frequency, you would have to do some fancy conversions yourself. But I don't think any other bonds are different than semi-annual. I think semi-annual is the baseline. Okay. All right, so that's all not very interesting. I'll just review, right? So now I want to talk about something that's has been in the news within the last year. We're going to talk about sensitivity of bonds when interest rates change. Okay, so why is this important? This is important because many of the banking crises in the past is basically due to this reason that interest rates suddenly changed due to changes in inflation, and people's bond portfolios got destroyed. And my takeaway here is the following: interest rates will basically kill the value of fixed income because the discount rate increases, which increases the denominator in your present value calculation, which basically pulls them down towards 0, right? So when interest rates rise, long-term debt with long maturities will get destroyed, basically. And that's exactly what happened to several banks in Silicon Valley recently, right, due to inflation. And we'll talk about that soon. But let me demonstrate sensitivity of bonds to interest rate changes. So suppose you have a change in the price of a 30-year zero coupon bond when interest rates rise from 4% to 5%. So here, let's do some calculations. Let's do it together. So let me see, I can find the plugin here. Okay, let's run this. Cool. All righty, so let's do some P0 equals 2. So how do you price this bond, okay, at 4%? So let's calculate the price of the bond at 4% interest rate, and then calculate the price again at 5% interest rate, and then calculate the percent change. That's the exercise. So suppose we are at 4% with 0 coupon. It looks like this to calculate it. Oh, let me do fractions here because it looks ugly otherwise. Okay. All right, 100 divided by 1 plus 4% to the 30th power. We're assuming we're compounding annually, okay? Cool. So that's, well, I'm not done yet. Sorry. And that's equal to 30.83. So just, you can confirm on your own time, okay? So that's our price of our bond when we have 4% interest rate. So suppose the yield curve is flat, okay? And we're talking about just 4% annualized, 30 years out, take that 4%, discount by 30 all the way to times 0. The price therefore is 30.83. Okay, so now we can see, cool, I can kind of just copy it. So the difference now is we're changing the 4 to a 5%, right? Everything else is the same. If you compute this with your calculator, you should get a number that's 30.14. And let me put a prime dash or apostrophe on the P to indicate that it's a different price. All right, so to calculate the percent change in delta P, it's delta P. That's easy, right? You just take the difference, 23.14 minus, let me do fractions instead. 23.14 minus 30.83 divided by 30.83. That is equal to negative 24.9%. So very sensitive to just a 1% change is a lot, but 24% is a lot more than 1%. All right. So we have that as our baseline, right? We have a very long maturity bond, 4 to 5%. And we find that changing the interest rate from 4% to 5% decreases the bond price by around 25%. Now, as a comparison, let's look at the change in the 10-year zero coupon for the same change in interest rates. So we do that. So the difference now, it's rather than 30, it's 10. And the value for the price should be 67.55. And for the P prime, changing it to 5, but instead of 30, it's 10. And the value therefore should be 61.3. Create. And therefore the final price percent change, is going to be 61.39 minus 67.5 divided by 67.5, which is going to be just minus 9%. Okay. So the first thing you should note, right, is we changed the 30 to the 10, and we noticed that the sensitivity of the bond price is drastically different. This is minus 25% versus minus 9%. So what you should be thinking maybe is, well, maybe it's because, this is a pricier bond, right? Maybe this is just a more expensive bond because there's more coupon payments. Well, that's in the right direction. So maybe you're thinking, well, if we increase the yield to maturity, you will increase you will decrease the percent change, right? Sorry, it's be the yes, decrease, because it's more negative, right? More negative. So maybe you're thinking, well, maybe if I change the maturity from 30 to 10, that would mitigate my exposure to interest rates fluctuations. That's partially true. Okay, that's partially true. As I'll give you another example, it will demonstrate that we're not just talking about more cash flow payments. I'm going to show you a comparison a 15-year bond, but instead of just one final payment in 15 years, you're going to have coupon payments intermittently. And you'll find the intermittent payment 15-year bond will have actually even less sensitivity to interest rate changes. So let me do the same exercise, but now for a 15-year bond, okay? But now it has annual coupon payments of 10%. Same change in interest rates. So if we do that again, let me just quickly do this. Now we're talking about 15. Oh, this is going to be, it's a little bit more complicated. So let me just write the formula. 10 over 4%, 1 minus 1 over 1 plus 4% to the 14th power. Cool. And then plus one final bullet payment of 110 and 1 plus 4% to the 15th power. That should give you a number that's 166.7. Great. All right, anyways, sure. All right, so I hope you recall your annuity formulas, right? 10 over 4% is 10%, sorry, $10 starting from tomorrow all the way to infinity, right? Discounted back to time zero. That gives you precisely this number. And then this minus 1 over 1 plus 4% to the 14th just means that I'm looking at, so ignoring the minus sign, it means I'm looking at the same infinite cash flow, but starting 14 years later. So when I take the difference, I just get this kind of cash flow between 1 and 14 years, right? So maybe I draw a line just to refresh your memory, right? So we have 0, 1, 2, all the way to 14, all the way to 14. So I'm looking at cash flow payments from 1 to infinity, and then I'm subtracting starting from 14 to from 15, right? 15 to infinity. So all that matters is actually this part here, which is this term here, right? That's your annuity math, right? That you learned last semester. Okay. And then one final bullet payment, right? That's 110 discounted by 15 years. And then you get 166.7. So let me borrow this again, and then the difference now is that we have P prime, but now it's 5% everywhere, right? That's the difference. And that number should be 151.91. Okay. Okay. And therefore, if you calculate, I'm just going to write this because it's a little bit hassle. The percent change in P, if you calculate it, it's going to be negative 8.5. So surprisingly, a longer maturity plus coupon payments gives you price sensitivity that's even less. So there's some right, there's some hedging going on with having cash flows, right, intermittent cash flows. So the takeaway here is that you should interpret bond interest rate sensitivity as how soon you are receiving your cash as opposed to maturity. So with intermittent cash flows, right, 1 year, 2 years, all the way to 15 years, you're pulling cash towards you faster, right, as opposed to just one bullet payment 15 years later. And so your exposure to interest rate risk can be mitigated if you can somehow pull in cash flow from really far into the past all the way towards the future, right? And so that's why you see like bond portfolios with very long maturities. When interest rate change, it really destroys, right, the cash flow far into the future. Whereas the cash flow that's closer to you, not so much affected, right? Because of this compounding effect, right? 15 years, 14 years, it really, really matters in the long term. So the conclusion here is 15-year coupon is less sensitive to interest rates than 10-year zero coupon, right? Interestingly. And the reason why it's less sensitive is not because of the maturity, as we showed, right? This is a longer maturity. The difference is that there's intermittent cash flows. You're receiving more cash earlier, right? So it's the average time receiving cash flow is lower, right? So that's the definition of duration, right? The average time you receive your cash flows for specific fixed income. So duration, as I said, your average time that you get your cash, and when it's average based on the proportional value of the cash flow payments, right? So cash flow one is divided by the price of today. Sorry, the present value of the cash flow one is divided by the price of the bond today. The present value of cash flow two divided by the value today. So percent, right? It's a percentage of the total value of the bond, weighting the time. So this is 1 year, 2 year, all the way time t. So duration, therefore, is the weighted average of how soon you receive your bond. So you are therefore more exposed to interest rate changes or interest rate risk if this number is very large, right? Because that means it takes a long time to get your money back. All right, so example. Suppose you have a 2-year, 3% annual bond with face value $100. Suppose the yield curve is flat, so we only care about 4%. What is the duration of this bond based on the definition above? So again, I'm doing a weighted average based on the proportional value of each cash flow payments relative to the price, the bond price. So first things first, obviously calculate the bond price, then calculate the present value of each of the cash flow, find the weights, and then weight each time. That's what you should do. So that's exactly what we do. So we find the price, 98.1. Okay. We know the coupon payments, and therefore we know each value, present value. So this is the coupon payment value discounted back to time zero. This is the final bullet payment discounted back to time zero. So these are the numerator of the weights. So 2.88 divided by 98.11, that's this, right? 95.23 divided by 98.11. So we multiply this number by 1, multiply this number by 1, and that's your weighted average time you have to wait to get all your money. So duration, boom, right? So about 2 years, but less than 2 years, right? So just based on this exercise, you can tell if you have a zero coupon payment, then the duration of a bond is equal to the yield maturity, the time to maturity, right? The time to maturity. So K if zero coupon duration equals years to maturity, right? Because the entire weight is 100% on the number 2, right? So that's why it's 2 years is equal to duration. All right. So if we want to derive an explicit formula for bond price sensitivity, we can, and then we can see where duration comes in to this explicit form. So let me tell you in 2 lines how to prove it yourself. So let me do that quickly. So in a simplified universe in which we have annual coupon payments as opposed to semi-annual, to make the math cleaner, it would look like this. P equals C divided by plus R plus squared plus dot 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 plus one plus R to the power of T plus what, shall we? Sorry, just T. I'm thinking. Okay, so that's our starting point, right? So let's create this. That's our starting point. And now let's take the derivative with respect to R, right? Calculus. Calculus is everywhere. So how do I do that? Well, it's simple because everything's linear. So if we take the derivative of frac dp with respect to dr, and then let's divide both sides by 1 minus p. Then we will get the following expressions. Negative so I'm going to just give you this simplified expression so that you can see where duration comes in. It's going to be negative, pull this out, 1 over 1 plus r, and then it will be c divided by, sorry, it's the fractions, c divided by 1 plus r plus 2, sorry, frac 2c 1 plus r squared plus dot 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 time t times ft plus c divided by 1 plus r to the capital T. And then 1 over p. So what do you see? You see duration right here, right? This is 1 year, 2 years, 3 years, blah, blah, blah. But then look, I'm scaling everything by 1 over p, right? So c over 1 over the present value of c, right? C divided by 1 plus r is the present value of c divided by p. C over 1 plus r squared is the present value of c 2 years from now, divided by p. etc. And so actually, sorry, this entire term, right? This entire term is duration, right? So this is the simplified formula I usually give to MBA students because they don't like math, and fair enough. But now you can see where duration comes in. It's here. The negative 1 plus r is this term here, right? This is here. And then the change in r is simply moving this to the other side, right? We move that to the other side. That's here. Okay, so the percent change in the price, which is dp over p, right, is the negative duration discounted by 1 plus r times the change in r. So that's why it looks like that. Okay. All right, so to recap a little bit, duration is the average time it takes for you to get your money. And it's a weighted average based on the value, the proportion of the total value of the bond price that you receive every period, right? The present value. And you wait the time that you have to wait to get to that, to get those cash flows in the future. That duration appears precisely in this expression here. Again, this is the percent change in P, right? And you see it here. So the higher the D, the more negative the percent change, right? So that's the formula. All right, so what does that have to do with what happened recently? Well, in comparison, back in the 1980s, mortgage banking was huge. And mortgage bankers made a lot of money doing mortgage lending because it was very easy to write loans and also very easy to make the difference. They borrowed at 3% and they lent out at 6%, and they went to golf at 3 p.m., which is why it calls 363, because they literally make the spread and then just go home. It was very easy to do. But this became problematic because, as you probably remember, inflation was a huge issue, and interest rates rose to about 3% to 9.5, all the way to 12%. Okay, so imagine going from 3 to this much. It's crazy, right? So the problem now is that they've already written or issued a lot of mortgages that paid out only 6%, right? So they have loans out, then they have cash inflows that's only 6% annualized, right? But the cost of borrowing and rolling over their loans has ballooned to 12%. So they have a mismatch in duration, right? They have liabilities, short-term liabilities. Where does it come from? They have deposits, right, which needs to be serviced immediately, and they also have new loans that need to write that pays now, in which that requires them to pay out 12%, but they're only getting 6% back. So there's a mismatch in duration, right? Same thing happened during just last year, I think, right? Last year, Silicon Valley Bank, they borrowed at 0% and they lent out at, say, 1%. But inflation required the central bank to elevate interest rates all the way to what? Like 5%. So duration mismatch again. You have cash flow coming in that's 30 years, right? That's coming in at 1%, right? So you wrote loans to companies that only paid interest payments about 1%. But now, if you wanted to borrow money, you had to borrow at 5%. So again, you have to pay depositors 5%. You are trying to borrow at a higher interest rate. And of course, there's a mismatch of cash inflow and outflow. Okay, so hopefully that's clear. So in the 80s, it was the Federal Savings and Loan Corporation that had long-term, so this is 1980s, had long-term loans with fixed interest rates, lower lower than borrowing rates, went up to 12%, ran out of capital, could not generate enough money to pay off liabilities. So Silicon Valley Bank crisis is same story. So if there's anything you learn from finance, is that people don't learn from their mistakes. I mean history. Okay. Okay. So if you were a risk manager and you were a risk manager at a bank, this is something you definitely should pay attention to, right? Your duration of your bond portfolio. All right, so before I take a break, I will just finish off how to bootstrap the term structure because you need to do this in your case study, which I will give to you maybe 1 or 2 weeks from today. Okay, so computing the term structure. So, okay, the yield was, okay. So remember, the term structure of interest rates does not assume any sort of coupon payments. So using the yield to maturity of treasury securities or any sovereign debt, for example, as the term structure of as the interest rate to discount things would be incorrect. Okay, you need to find some way to convert coupon payments to zero coupon bonds in order to construct the term structure. So certainly for T-bills, treasury bills, because there's no coupon payments, you can directly use the yield because the yield is precisely the term structure of interest rate, right? But if you have coupon payments, then you need to do some conversions. So in general, for example, if you have R2 as the proper interest rate for the term structure, but the 2-year note Y2 is the yield, typically, obviously, right, R2 is not going to be equal to Y2 because there's going to be a positive coupon payment. So as I said, so let's go over some examples. So as I said, suppose there's if we have a 1-year zero coupon T-bill, we know that the yield is simply equal to the proper term structure of interest rate for 1 year. If you have a 1-year zero coupon bond, it's the same thing because there's no coupon payments. You can back out the bond quite easily. So if it has a value of $90 and has a face value of 100, you just divide by yield to maturity. Solving it is quite simple, right? -1. So zero coupon bonds often called pure discount bonds because yield is the discount rate. So this is a very, very dumb exercise where I give you the zero coupon bond price and you back out the yield to maturity, which is equal to the proper term structure of interest rate value. So here I give you the price. So let me just tell you what I have here. I have maturity, 1, 2, 3. I have the price, blah, blah, blah. I have the par value, $10,000. Do the same thing here to back out R1, R2, R3, because it's just one final bullet payment at the end of maturity, right? So it's very simple to back it out. The only thing you have to watch out a little bit is the fact that it's to this these the yield to maturity is annualized, so you have to take it to the proper power. So this is 1/2 and 1/3 because I've taken the yield to maturity to the second and third power, etc. So very easy to back out, right? You just take the par value divided by the price, subtract 1, you get the term structure of interest rate value for 1 year, 2 year, 3 years. So in general, zero coupon security is not available, obviously. So what we have to do, we have to what's called bootstrap the term structure of interest rates by formulating a portfolio of bonds, much like swaps. So let me just jump to the example. Here's the idea. If you can come up with a portfolio of bonds that precisely mimics a zero coupon bond, then the portfolio value is precisely the zero coupon bond value. And you can use that zero coupon bond to back out the yield to maturity, right? Because all you're trying to do is combine different cash flows that look like a zero coupon bond for a certain maturity, and then use that price and par value to get the proper term structure of interest rate. So in this example, suppose you have two bonds. You have a 6-month zero coupon bond with face value of 100, and you have another bond, bond B, 1 year coupon bond with face value of 100 with a coupon rate of 10%. So if you look at the cash flows, it looks like this. For bond A, it's just one bullet payment of 100 because at maturity you get 100, right? Within 6 months. For bond B, there is two payments, right? This one 6-month payment and 1 year payment of $10 plus 100 par value, right? So we want to create a synthetic bond based on these two securities that gives us a zero coupon bond. Zero coupon meaning there is no payment at 6 months. We can do this, right? Because bond A's 6-month coupon payments perfectly aligns with bond B's coupon payments in terms of timing. And we simply have to form a portfolio that completely offsets this, zeroes out the 6-month coupon payment. So if we take 1/10 of bond A, right, in which case this 100 is divided by 10, and we subtract it, so these two cash flows cancel out precisely at 0, right? And so the final bond, this zero coupon bond now, this portfolio of bonds, is just a single bullet payment of 1/10 in 1 year. Right? Yeah, that's the idea. So I didn't give you any price values. So let's give you some price values. So suppose bond A has a price of 90, bond B has a price of 100. And with those numbers, you can now calculate the value of your portfolio and then use the portfolio to back out the interest rate, the proper interest rate for 1 year. So if you take the present value of the zero coupon bond right up here. So I'm writing ZCB for this portfolio of bonds, okay? Present value of the zero coupon bond is equal to 100 minus 90 divided by 10 because we're taking 1/10 of the bond A value, right? That's going to equal to 91. Okay, so with 91, we can then write the following equation. The price is equal to 100 par value divided by 1 plus R1, which is the interest rate, the proper interest rate for the zero coupon bond. And if you back out R1, it should be equal to around 20%. Okay, so this is called bootstrapping. We are trying to create the term structure of interest rates by creating portfolios of bonds to mimic a zero coupon bond in such a way that we can now back out interest rates to use for our term structure. All right, so for this question, I'm just gonna tell you the answer, okay? So here, a little bit more complicated. You have the following prices for bonds, each with $100 face value. They have semi-annual coupon payments. They occur at 6, 12, and 18 months interval. And so only C has coupon payments. Everything else is one single bullet payment, and we're given prices. So how do you formulate, how do you solve for, so first things first, let's solve for R 0.5, right? You can solve for that and also solve for 1 because these are zero coupon bonds. The hard part is solving for R 1.5, right? How do you do that? That's a bit tricky. So solving for R 0.5 and R1, simple, right? Because all you're doing is taking the power divided by the price. And I believe this is, I think this is 1 over. I think there's a typo here. No, that's right. That's right. No. I think it's this. Yeah. No, sorry. It's 0.5. Sorry, that's right. Okay, yes, that's correct. All right, so that is very easy to back out R1 and R half and R1, right? R1 and a half is a little bit harder because you have to cancel out all bullet payments, so half a year and 1 year. This is the timeline of the bonds, cash flow timeline. So bond A has 1 bullet payment 6 months, bond B has 1 bullet payment 12 months, and bond C has coupon payments 3 times, right? 6 months, 12 months, and 18 months plus par at the end. So what we can do here is we can divide by 3 over 100, right? Here we can divide by 3 over 100, and therefore we can zero out everything, right? And so we just take 3 over 100 for each of these values, right? And add them up. Or yeah, and then subtract bond C, right? Or bond C minus everything else. Okay. So this is exactly what I did, right? Bond C minus everything else, 3 over 100. This will create this synthetic bond, right? Zero coupon bond that has 1 bullet payment. And you just use, you know, the bond pricing methods for 1 bullet payment in 1.5 years to solve for R 1.5. Okay, so that's my bond review. Sorry if it was redundant, but I feel it's necessary because you'll be using the things I mentioned here in the case study. And also, this is a good recap in case you forgot the fundamental concepts of bonds. All right, so let's take a 10-minute break and we'll come back and we'll talk about swaps. No quiz today. Oh, yeah. Yeah.
I want to know when the final exam will be due.
Let me check. I think it's in May something. Um, I don't know exactly because it's not official. Um, I have it written down on May 10.
Oh,
I think it should be in your student portal or whatever, right? They should tell you, but that's the date I have in my calendar. Okay, May 10, 6:30 to 9:30.
thank
But
you.
don't take it as the truth because it's not official. Yeah.
所以我就寻思，看到所谓。这个学期不会向上，已经考3完。我们4月30号，4月3号。然后在这个等到是这个对呀，这就会上回去了。是325，对啊，这个会全在，都有刚开始。然后20个那个，对，然后4月那个就是，所以说你觉得前期有来意。主要是对你们可以研发的开的考啊。第一门光彩都很明显。咱们店也号在这个4月2号和4月10号，5月啊，是不知道，我之前5月4号。5月4号啊，这还能不熟了？国金5月10号，可啥不晚了？可啥还差？原本有10就。刚才说28号在系统里出了，28号在系统里就有了，高三。5月10号。我这么晚，一会儿就开始讲了。有2周吗？加你给那个4月3号。哎，我们那个现场。4月3号开始。我这知道。4月3号多少？5月1号就是第2周的中午，跟飞那个当时开。我就怕他他妈30号一门，1号一门，2号一门，然后不可能啊！这2门1头1尾已经定下来了，剩2门。1号的部分已经定下来了，4号4号是也定了。我猜在7号，没考7号，我1号在7号。啊，对，这个我们统计的就是1号在7号。我相信。还有什么不行不要的？是有用吗？没有用啊！没有不好，我完了。我刚才我还没知道在玩，好玩。 刚才是吧？然后这要看，不然你看连这个哪怕是哪？要多少多少书本儿，我还记得，我来一场。6部里面，整个6部里面唯独没写的剩下的都是三个，然后还是啊，说跟这个理论变词一样。我给你你知道吗？你知道吗？你知道吗？我这2天，我手搓的那个复利和 PPT， 我拿Excel 输的。不是。我只能说没结账。啊，不是。周一的柜子呀。不是。我不给你们扣钱，不能只有我难受。不是，我这么跟你说，我掏了一个10阶的。我们也操。然后他妈的。操吧。会有用的。对呀。对。大概有用。是吧？题是已经知道。题已经知道了。我没看，我这2天就是在那手搓那个 PPT 的东西。没有用，我搞了一遍，发现屁用没有。我太好了。当时是在上一节课上，然后我一看到那个，还是上一个。我要紧急从那个回家里面把它拉好浪费了。然后就导致我有个算出来没信息，过于浪费了。这个老师这个我也是。
All right, everyone. Let us begin our dive into swaps. So, I imagine most of you had some exposure to swaps, and so what I'm going to do is just review a little bit of what you learned, and then introduce to you what's different for Forex when you have FX exposure. Okay, so types of swaps. So terminology before I begin. Swaps have, as you know, 2 sets of cash flows. Each set of inflow or outflow is typically called a leg. So if it's a floating for fixed interest rate, for example, so imagine you have a bond that pays a fixed interest rate from now until 30. That's an outflow. And your inflow is a variable interest rate that changes based on market forces. Like it used to be the LIBOR, nowadays it's called something else. That leg would be called a variable leg. The fixed leg is called a fixed leg. That's how it's usually we use the terminology. If it's different currencies, but fixed for fixed, we use the leg to denote the type of currency. So if it's US dollars, then it's US leg. Japanese yen is called Japanese leg. Okay. Each swap payment occurs simultaneously, and it's netted out, and payment is made by the party that owes the money. So it's not always the case. You don't need to actually make the physical transfer. You just take the net, and whichever nets out more positive gets the cash. Okay. Swaps, as I said, are OTC because they are so. They're typically very complex, and you probably need to find a very specialized counterparty in order to write a proper swap contract. There is no organized secondary swap market, again, meaning that you have to find the counterparty to do a separate counterparty on your own. Okay, so if you want to, so it's complicated, right? Which if things are OTC, that just means that if you want to unwind your position, let's say you no longer want to engage in a 30-year swap, you want to stop at 15 years, it's very difficult to do that because you need to find another counterparty who's willing to take over your spot, or you have to write some sort of mirror swap in order to cancel things. So it's not as simplistic, right? Maybe the way we evaluate is simple, but in actuality, if you want to unwind your position, it gets very complicated, which we will talk about. So here, yeah, right. Unwinding swap is not easy. So I'll talk about different ways to unwind in a bit. Before we do that, types of swaps. So interest rate swaps, I think, is what you learned in your derivatives course, right? It's usually a fix for floating. And why would one want to do fixed for floating? Well, some people may have better ability to service interest payments that are floating as opposed to fixed. And people we expect firms or institutions to specialize in the type of interest rates that they can service, right? And so if you prefer variable interest rates, you can engage in a swap, right? Another way why you might engage in a swap is because variable interest rates are less exposed to duration risk, right? So remember, the problem with fixed income is that your cash flows are fixed, right? Fixed every 6 months all the way to 30 years. But you can mitigate your duration exposure if you swap those fixed interest payments with variable ones. Why? Because as interest rates rise, so does your variable interest payments. So there's many, many reasons why you would prefer a floating over a fixed, for example. All right. So don't think of it as just like something doesn't make any sense, right? It's just something arbitrary. There is a reason why people want to do this, right? Because people have different advantages and disadvantages, and they want to find a fair exchange, right? A win-win scenario in which everybody is better off with lower borrowing rates, right? And I'll show you an example why swaps is a perfect demonstration of what finance is about. Right? It's about risk sharing. And with swaps, you can find this win-win situation where everybody is specializing in their preferred borrowing rates, and everybody is better off in the end. All right, currency swap, same idea, right? Not just fixed for floating, but you also have different companies, institutions that prefer certain currencies. Again, could be because they have easier time servicing euro-denominated debt or US-denominated debt. Whatever the reason, these types of contracts do exist. So currency swap is typically fixed for fixed, but one type of currency for another. USD for pound, Chinese yuan for Hong Kong dollars, whatever. All these contracts could exist. And lastly, currency interest rate swaps, which is just a combination of these two. So you can already imagine, like, we're just compounding the sources of risk, right? We deal with currencies. Before, with interest rates, we're talking about risk coming from changes in the discount rate. As the term structure changes, you're discounting long-term securities, the cash flow of long-term securities, much more higher magnitude. So that's your source of interest. That's your source of risk, right? Interest rate risk. But with currencies, now you have an additional risk factor, right? You have currency value changing. So every time you change, right, you have to look at the FX market and figure out whether or not the cash flow coming in will exceed the cash flow coming out after currency conversion. So another source of risk you have to think about. We're not going to evaluate a time series model of how E evolves, okay, when valuing swaps. We're just going to assume that E is constant unless we say something changes. In which case, if it does change, we're going to say the change persists until all the way to maturity. So that's just for the sake of simplicity for this class. I imagine if you take a credit risk class, you will find some way to model interest rate fluctuations over time. Okay, so that's the idea, right? So let me give you how I visualize swaps using a timeline in the next few slides. So what I will usually do is I'll draw a timeline from perhaps 0, 1, 2, all the way to time t. And I will say counterparty 1 will give something to counterparty 2, and counterparty 2 will give something to counterparty 1. All right, I'll write it something like this. And usually, what does C1 give to C2? Maybe it's fixed rate, maybe it's R, maybe it's a variable rate, whatever. It could be LIBOR. I'll just write maybe R with the squiggly line for variable rate, right? So that's what I'll write to denote a swap. So what I wrote here is that every period, C1 gives C2 a fixed R, but C2 gives to C1 some variable rate. So there's an exchange of interest payments every period. Currency swap is not R, it's actually you're exchanging you're doing an exchange rate, right? It's just C1 gives C2E, right? And C1 gives to C2 gives to C1, 1 unit of the foreign currency, right? That's what currency swap is. And then currency plus interest rate, we won't touch it, right? It's a little bit too complicated. Okay, so it's not just about cash flows, right? We all learned about, it's not just about intermittent cash flows. Sometimes you can write swaps that's conditional on an event. So this is some invention that was created around the time of the financial crisis. And what a credit default swap is it is a side bet on whether or not a specific bond or security or specifically bond will default or not. So if you go long, the long leg of a default swap, you're actually betting that there is a default. Okay. This is not important for this class, but just to give you a review again. Okay. So credit default swap, the long leg, you are seeking protection, right? You're betting that there is going to be a problem, someone servicing the debt, and you want to buy insurance essentially. So you're betting on default. Your short CDS means that you're seeking the premium. So you're betting no default. You're hoping that nothing happens and you just get premiums. Okay. So you can already guess who are the ones shorting the CDS. They're the banks, right? The people issuing. The ones that are not seeking protection, right? They think the mortgage securities are super safe. No default is going to happen. So if you want to write it in the timeline format, it would look like this. So 0, 1, 2, whatever. Every period you check if there's default or not, right? Default, question mark. If so, then C1 gets a premium. C2, sorry, if no default, C1 gets premium. If no default, C1 gets premium. So right, if yes, C1 gets premium. Sorry, if no, sorry. If yes, C2 gets par value, right? That's insurance, right? So you must have learned from your derivatives class, right? That the basic formula to price CDS is the following. It is present value of long CDS position minus the present value of short CDS position, right? And that's usually called the CDS spread. Of course, this equation can be very complicated, right? The present value equation, you may need to model how default arrives, right? That's like a Poisson kind of distribution or whatever. And the arrival time, you're modeling the arrival time. So it can be very complicated. We're not going to talk about that in this class. We're just going to think about risk-free bonds, okay? So we're just assuming that all CDS swaps are more or less risk-free. Okay, let's see. All right, complications with swaps. So I give you 3 different ways to stop swaps if you don't want to engage in the swap forever. So remember, swaps typically are very long term, maybe 10 to 30 years, because businesses operate in different countries, or they have some project with some long-term timeline, and right, they engage in these long-term contracts. But sometimes things don't go the way they want, and they want to stop the swap. To stop the swap, give you 3 ways to do it. One way is just to buy out your position. So you pay your counterparty the fair value of your all future cash flows, and hope that your counterparty is okay with that, right? So remember, the original contract is this: you're exchanging between some counterparty C2, right? C1 gives C2X, C2 gives C1Y, and we just hope that, for example, if C1 no longer wants to give out X, perhaps C1 can just pay PV of all future X, right? To basically buy off C2, right? Right. You don't want to keep emitting cash for 10 years. You just want to walk away. And one way is to just say, here you go. Here's the fair value of all the price, all my cash flow in the future. See you later, right? Problem with this is your counterparty may not be okay with that, right? They've engaged with a contract with you for a reason, and they expect it to be fulfilled for the long term. And they may not accept a fair value of whatever price you would, even if you put it on a margin, for example, like maybe 1%, 2% on top of this fair value. All right. If that's not good, if that's not possible, then maybe you can write what's called a mirror swap. So imagine you still have this arrangement in which you are paying C2X and he's paying C1Y, and you simply write a mirror swap in which C2 will pay you X and you pay it Y. So the difference, however, is it's possible interest rates have changed, right? So the value of the mirror swap may be different, right? It's supposed to mimic what's left, right? So maybe after 10 years in a 20-year swap, your economic conditions have changed, interest rates have changed, exchange rates have changed. You're writing a reversal, but the cost of this reversal may be expensive, right? Because again, borrowing rates are different, exchange rates are different, blah, blah, blah. And so may not always be feasible, right? It may actually enhance counterparty risk. And lastly, what you can do rather than engage with your original counterparties is you find someone else to unload your position. That's probably the best, well, not best, but assuming all things go well, you're allowed to kind of walk away, but you can it's still possible to have counterparty risk because you still have to service cash flows, right, indefinitely. And if your additional counterparty defaults, then you're in trouble, right? So let me tell you what happens. You have C1, same setup, right? C1 giving C2 something, C2 giving back to C1 something, but C1 wants to walk away, so it redirects this Y to somebody else, perhaps C3. And C3 will give you X. So do you see? So he's channeling this inflow to C3, and he's channeling this X to C2, right? So this X goes here. Sorry, this X goes here. This Y goes here. So it's as if C1 is not necessary, right? It's as if C1 is not necessary. But as again, because you have an additional counterparty, things could go wrong for this C3 person. If this C3 person suddenly disappears, then you're in trouble, right? So you've actually created systemic risk, right? Because now you have more people involved in a more complicated swap agreement. All right, so to summarize what you can do to terminate swaps. If possible, I guess the best outcome is just you can buy out your position, right? You just sell your position to C2, pay a lump sum, and you walk away. Done, right? You've unwound. If that's not possible, maybe you can write a mirror swap, right? It's supposed to be the exact opposite of the cash flows that's exchanged with your original counterparty, but it's going to cost you. It potentially could cost you more money because the economic environment has changed, interest rates has changed, and exchange rates could have changed, and so you could be amplifying counterparty risk in this fashion because again, very expensive to you or to the counterparty, etc. And you also have to make your counterparty agree to the arrangement. And lastly, you could try to unload your position to somebody else, right? So in this case, where you're exchanging with C1 is exchanging with C2, you've introduced C3 into the network, right? But by doing this, you're creating systemic risk, right? We're all interconnected somehow. Yes, you've unloaded your position to somebody else, but if that person disappears, something you're still responsible, right, for transferring Y and X to people, right? So may not be ideal, right? So these two may not be ideal. Different types of risk is amplified. Obviously, the best is if you can just pay off your counterparties to go away. And but anyways, not all three strategies may not be feasible. All right, so swap usages. So this is where I talk about. How swaps actually reduce overall risk for people. So if there's one takeaway from studying finance is that everything you learn in finance is at the end of the day about risk sharing. Okay, and swaps is a good demonstration that with risk sharing, everybody is better off because with financial innovation, with sophisticated financial contracts, you can distribute risks to those who can tolerate best. Okay, so let me show you the example of that risk sharing using swaps. So take this setting for example. So in this table, you have two firms, firm A and firm B, and you have two types of interest rates. You have a fixed rate and a floating rate. For firm A, the fixed rate is 9%, and the fixed rate for firm B is 10.5%. So the difference in interest rates is negative 1.5%. So what that means is that firm A has a better deal if it wants to borrow money. It could be because it's less risky, right? And therefore, banks and financial institutions are more willing to lend money to them at a lower interest rate. Okay, so firm A less risky than firm B. Floating rate, firm A is some variable rate LIBOR. So of course, I haven't updated my slides, but LIBOR no longer is used. There's another interest rate. So let's call it what it is. It's SDFR. So FDFR is the secured overnight financing rate used by US benchmark. US dollar benchmark. So sorry, let me just type it out. SDFR. Okay, so that stands for secured overnight financing rate. But anyway, some variable rate. And firm B has SDFR plus 0.5%. The difference between borrowing rates and for firm A and for firm B for floating rate is also negative 0.5%, indicating that firm A also gets a better deal for variable rate. So far you should conclude that firm A is less risky than firm B. It can always get lower borrowing rates. Firm B is riskier, higher rates, no matter what kind of rates is being offered by financial institutions and intermediaries and banks. But that's not the point here, to show that these banks have different riskiness. What I'm going to show you now is that firm A and firm B have different comparative advantage at in borrowing certain interest rates. Okay, so in the bottom row, I have the difference between fixed rate and floating rate to show you the rate that they're giving up when they borrow floating over fixed. Okay, so they're giving up fixed, and the opportunity cost or opportunity interest rate they're giving up is 9 minus LIBOR. For firm B, if it chooses floating instead of fixed, they are giving up 10 minus LIBOR. So when we're talking about interest rates or borrowing rates, lower is better, right? And what this is saying is that firm A is giving up much more when borrowing floating rate than firm B. And so firm B has a comparative advantage in borrowing floating rate because it's giving up, it has a crappier interest rate otherwise, right? 10.5%. Agree? So let me say that again. We're looking at the opportunity cost of borrowing a specific interest rate over the other. I'm saying firm A has an opportunity cost of borrowing, when borrowing floating, it is giving up 9% fixed rate. And so the opportunity cost of doing so is 9 minus LIBOR. For firm B, it's 10 minus LIBOR. Compared to firm A, firm B gives up less, right? Because 10 is bigger than 9. Remember, more is bad, lower is good, right? So firm B gives up less, lower opportunity costs when borrowing at a floating exchange rate. Interest rate. So that's what I wrote here. B is foregoing 10%, whereas A is foregoing 9% for the same floating, right? And I'm going to show you that if each firm specializes in the interest rate that they're best at borrowing at, and they engage in a swap agreement, they can come out with lower interest rates, borrowing rates than before. Okay, so I'm going to give you one solution that's a win-win for both of these firms. So to summarize, we're going to allow firm A to borrow fixed because it's good. It has a relatively better rate than firm B. So we'll let firm A specialize at borrowing 9% for, let's say, 7 years. And we're going to let firm B borrow at the variable rate plus this margin of 0.5% because it's riskier for 7 years. And then we're going to allow firm A and firm B engaged in a fixed for floating swap agreement. So what that means is that we're going to try to let firm B pay a fixed and firm A pay a floating. Okay. So remember, firm A is borrowing at what it's good at. It's borrowing at the fixed 9%. B is originally borrowing from the financial markets, some variable rate plus 5.5%. And now we're asking these two firms to engage in a swap in which they're trading fixed for floating. So if you're originally borrowing fixed, you're going to take floating. If you're originally borrowing for floating, you're going to take fixed. So B now pays fixed. Let's say they found an agreement of 9.5%, and firm A agrees to pay firm B LIBOR. Okay, these are just random values. Suppose they found these two numbers that they agree upon. So the final borrowing cost for firm A is 9%, right, which is the original rate they borrowed from the banks, plus the variable rate, because it promises to pay B, minus 9.5%, which is what firm pays firm A a fixed. So 9% minus 9.5% is LIBOR, or sorry, a variable rate minus LIBOR, right? Which is less than LIBOR. So if you look at the previous slide, LIBOR minus something is less than just LIBOR. So we found a new space, right? Essentially, a new borrowing space that allows these two firms to lower, at least for firm A, right? Lower its cost, borrowing cost. Now look at firm B. So firm B originally was borrowing at some variable plus margin of 0.5%. It is paying fixed sorry, it is yes, paying, I think there's a number is missing here. No, it is paying fixed, okay? Yes, it's paying fixed and it's going to receive LIBOR. So it's going to receive LIBOR, so LIBOR cancels out. And it's going to be paying fixed plus fixed 10%. So 10% compared to what you saw previously, 10.5%, right? We see that with these two numbers plus swaps, there is a borrowing space that's better for everyone. So the total borrowing cost saved is 1% because there's a decrease of 0.5% for firm B and a decrease of 0.5% for firm A. So both receive lower rates than if they had borrowed without risk sharing with a swap contract. So at the very least, your understanding of finance, this is what it's all about. You come up with contracts, whether it's, swap contracts, bonds, equity, callable bonds, forward contracts, all this stuff is really about risk sharing. Okay, that's what finance is really about. Okay, lowering financing costs. Comments, questions. Hopefully that example was clear. So just to recap my point. So swaps. It makes sense from a strategic point of view, from a project base, because again, different currencies, you prefer to work in different currencies because your tax liabilities in a certain currency, and therefore you engage in swap because you're operating in a foreign country with different currencies. Makes sense. But at the end of the day, it's being about taking on the risk that you're better at taking, right? That's what risk management is about. You pinpoint the risk you are your best at taking, and you try to trade the risk away to others in exchange for less exposure of that, right? In other words, risk sharing. So you can do that with swap with variable for fixed. You can do that with exchange rates. You can do that with exchange rate plus variable. All these things just enlarge this contracting space, right? That's what we're talking about at the end of the day. Enlarging the contracting space so that counterparties have more room to figure out their needs and to minimize risks that they don't want to take on. All right, so let me give you other sources of risk that you have to think about when you engage in a swap contract, okay? So imagine we have an original contract at a fixed rate for 10 years at a yield of 7%. So suppose we have C1 giving to C2 7% for 10 years. So rather than doing that, you could convert this liability to the following. So imagine you found another way to convert this to a variable rate of Euribor. So this is the European LIBOR, which is still used, so I won't change this. Euribor, but you would have to roll over this contract for every 6 months. Right? So CP stands for commercial paper. So imagine we have, so that commercial paper just means uncollateralized borrowing. Okay, and yeah, okay, and here it has interest rate of Euribor plus 0.5% that you have to potentially roll over every 6 months. Suppose you found such a swap contract in which you get this, but you have to roll over, and you only pay fixed for 6%. So you would so rather than, so this what this means that you're going to get 6%, and then you're going to give out Euribor this instead, right? So your final yield is going to be 6.5%. Okay, so but the problem with this So let me write this down. Oh, sorry. So C1 gives to C2 Euribor plus 0.5%. And then C1, so with the same counterparty, right? You engage in such a way that you get 6%. Okay. So over 6 months, swap floating for fixed. Oh, sorry. One more. This the swap is floating for fixed. So actually, there's a minus here. So you're swapping. You're still giving out. I'll just type it. Yeah. So the Euribor is canceled out because that's the swap agreement. But you are still paying off. So this is C3. Sorry, there's another counterparty. Okay. So you're still paying 6.5%. Oh, sorry. I think we're just comparing. Sorry, my bad. I'm studying my own notes. Okay, so you can do this. Okay, you can do this, or you can borrow commercial paper and then engage in a swap. So two different strategies. Okay, so strategy one is you engage fixed interest payments, 7% for 10 years. The other is you issue 6 month commercial paper. So that means you're paying this much, but then you engage in a swap to eliminate Euribor. So then your final payment is 6.5%. And so the problem with this is that there's rollover risk, right? Because we're assuming that you're able to keep borrowing commercial paper every 6 months, right? So even though the borrowing rate is lower, you're taking on a different type of risk, which may not be palatable to you, right? So just make sure that you understand the kind of risk you're taking on. So here we have rollover risk, and the other is credit risk. Sorry, I'm trying to understand if I wrote this correctly. Let's see. Anyways, I'll get back to this later if it doesn't make any sense. But I think that's right. Getting this out. Okay, sorry. It should be this. It should be you're receiving Euribor. Yeah, it should be receiving Euribor, but you're paying this out. You have to pay out more now, right? 6%. Yeah. So that's a swap. Sorry. So you're receiving Euribor, and that cancels out with this one because you're borrowing commercial paper. So 0.5% plus 6% is your final cost. Even though 6.5% is lower, it's different type of risk, right? You have rollover risk exposure, but the question is this rollover risk worth this minus 0.5% lower borrowing cost, right? Okay, so let's see. So let's talk about some examples. just how to calculate stuff before we get to the currency exchange stuff. All right, so this is general guidelines for risk management. I don't know if there's a risk management course, but if you want to summarize risk management in a nutshell, it's how to pinpoint exactly the risk you want to take on. Okay, if you believe in like efficient markets, right, then risk management is kind of pointless because shareholders would just diversify the portfolio, right? Then what's the point of risk management from the perspective of markets, right? It's pointless because shareholders, if they don't like the risk, they will just away from you, right, to maximize their portfolio. So that's maybe something you came across when studying Modigliani Miller stuff, right? There's a irrelevance of risk management, right? But in an imperfect world, things are not always like that. So if you want to boil down risk management to a single sentence, it's just about pinpointing exactly the kind of risk that your company or your institution wants to take on. So in this case, right, the example I gave you, if you're not okay with rollover risk, then you probably shouldn't take on that 6.5% borrowing rate because it may not be sustainable in the long run. If you want something safer, you might take the 7%. So it's important to know exactly the kind of risk you're willing to take on. And that's what risk management is about. So for swaps, I gave you the example of rollover risk, right? Despite having lower interest rate, rollover risk may not be tolerable from your perspective. But it could be even more general like that. If certain currencies are not palatable for you for investing, then you should write a swap to eliminate it, right? So that's what we're going to study. All right, so deciding the amount to hedge, right? That's when we get to the derivative stuff. I mean, the forward contract and the option stuff later on. Okay, so interest rate swaps. Let's look at some examples. Let me talk about how we're going to calculate it in this class. So in this class, we're going to interpret swaps again as a portfolio of bonds, which means there's a leg in which there's going to be cash emissions going out, and there's another leg in which there's cash emissions coming in. But we're also going to assume that at the end of the swap contract, they're going to swap the notional value, okay, which in bond terms just means there's a par value that's going to be exchanged at the end of the contract. So remember what a bond is, right? You have cash emissions every period, right, up to the maturity, and then one final payment of interest plus the principal. So much like interest rate swaps, you're going to have the same structure. You have equal distant intermittent payments all the way to maturity, and then you're going to deliver the final payment plus the notional amount. They call it a notional amount, but it just means principal. It works the same way. So the notional just means an arbitrary amount, okay? So given a notional amount, we determine an interest rate or a coupon rate that's multiplied to the notional rate to determine the cash flows, okay? So two firms trade a set of cash flow determined by a notional amount. So you can think of it as a loan principal, but it just means some amount of money, whatever it is. And given that amount, you determine the interest rate, the prevailing interest rate that you'll be swapped for floating. So if the interest rate is 5%, fixed rate, whatever it is, could be set by the term structure of interest rates. Say it's 5%, then that's the fixed rate forever, right? For every period, forever, not going to be changed. And then the other counterparty gets the floating rate, whatever that is, okay? And vice versa. So again, can be viewed as a sequence of forward contracts, but for our sake, for valuation's sake, we're going to price it just like bonds. So let's go through some examples here. So here we have two firms. We have FDI, I think it's a fake company, so Food and Drink Incorporated. And we're allowing these two companies to engage in a swap contract. it's engaging with Bank of America, B of A. So suppose the notional amount is $100 million, and it's gonna FDI is going to engage in a fixed for floating with Bank of America, in which FDI have to pay out LIBOR plus 3%, and so that means that B of A is going to pay 8%. Okay. So sorry, let me see. Sorry, it's a combination of two things. FDI originally is borrowing this, but is engaging in a fixed for floating at this. So 8% for LIBOR, and then it has a bond, outstanding bond that it's paying interest at LIBOR plus 3%. So this swap converts this loan to a fixed rate. So we have this liability first, and then, so let's write it out, sorry. So suppose we have this liability plus 3%. This is FDI, has to pay this every year. And now it engages in a swap in which it pays floating, agrees to, in which someone pays your LIBOR, so minus LIBOR, but you have to pay now 8%, right? And so the LIBOR is canceled out, and you get it should be minus, right? Sorry, that's right. Yeah. Right, cool. So it has fixed for floating. The swap has a maturity of 5-year maturity, notional amount of $100 million, notional amount which is like the principal loans, not exchange. Yes. Until at the time, so at the end is one final payment, right? It's 8% times 8 million, and B of A pays one final payment of LIBOR times 100 million. So let me characterize the agreement again. So ignore this original bullet point, this top one. That's its original loan. The swap agreement is 8% for LIBOR. So FDI pays fixed 8% forever. And I mean, until 5 years. And B of A agrees to pay FDI just LIBOR. They keep doing this every year for 5 years. In the end, FDI will pay one lump sum of 8 million times, it should be 8 million times, so $8 million, which is 0.08 times 100 million. But there should be one final lump sum payment at the end too. So I didn't write it here, but so if at the end for the last year, it should be 1.08, okay, right? Times 8 million. And it should be 1 plus LIBOR times 100 million. But there is, yeah, but so at the end of each year, they exchange these two cash flows, but at the last year, they have to exchange the notional amount too. All right, another example. Suppose SWD International issues a 3-year 10 million bond at LIBOR plus 2%. So they have liabilities of LIBOR plus 2%. And they want to create a fixed rate liability. So what they do is they engage in a swap contract with Citibank, and they will enter in a swap to pay a fixed of 7.5 and receive LIBOR. So so what they will pay is LIBOR plus 2% plus this fixed. They will receive LIBOR from the swap with Citibank, and we see that their final payoff is just 7.5 plus 2. So no more interest rate risk, right? It's just variable interest rate risk, right? They still have duration risk. All right, finally, currency swaps. So we're not going to be dealing with variable interest rates here. We're just assuming that interest rates when you engage in the beginning is fixed. So if you're exchanging 5% for 7%, it's constant forever. Okay, I mean until the contract ends, but it's 5% of a different currency. Okay, so if there is a change in interest rates over time over the course of the swap agreement, it will change just the discount rate, not the numerator. Just make that clear. So let's just get right to the example. So imagine we have a swap agreement where it's 5 years, it's a yen for dollar swap. So one counterparty is going to pay out yen, the other is going to pay out US dollars. The prevailing, let's just call it an average interest rate or 10-year interest rate, just one interest rate value, is 2% for Japan and 6% for the United States. So at the time of origination, it's important to note that nothing is exchanged at time 0. Does that make sense? There is no reason for you to engage in a swap contract unless both parties agree they're making a fair trade, right? So the cost of engaging in the swap contract at time 0 should be nothing, right? Because we believe your counterparty and you agree that whatever I give you, the time value of money, blah, 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 discounted times 0, the price of that must be exactly equal to whatever they're giving, and whatever I'm giving to them must be equal to the value they're giving to me. Otherwise, we would never engage in the swap contract to begin with. So the value of the contract is 0 at time 0. Do you make sense? Otherwise, you would never engage in the swap to begin with. Okay, so given that, now you kind of understand why swap value changes over time, though, because the economic environment changes, interest rate changes between countries, and now we have an additional variable of E, right? We have E potentially changing. So suppose the spot rate is the price of a US dollars is 100 yen, and let's assume an investor enters into a 5-year swap with a bank to receive 10 yen and pay out dollars. And let's assume that the notional amount, again, is an arbitrary amount of dollars or yen, is 100 million US dollars or 10 billion yen. So what that means is that you just take this interest rate and multiply by the same currency value notional amount to get the coupon payments or interest payments that you have to exchange every period. So example, elaboration. Each year for the first 4 years, so this is a 5-year swap. So for the first 4 years, if you are long yen, that means you are receiving yen. So here, 2% of 10 billion is 200 million. Okay, so you're receiving 2% on 10 billion, or 10 billion, that's 200 million yen. But you are short dollars, which means you're paying out dollars. So that means 6% times 100 million, which is $6 million, or if you want to convert it to yen, you multiply that 6 million by E, whatever E is. So in practice, only the leg that has a negative payoff will make a payment. But based on at the contract initiation, however, 2 cash flows cancel out, right? They must cancel out, otherwise you would never agree to this. In the final year, the investor will receive the notional amount. So each investor will receive their respective notional amounts. So if you are long yen, you will receive the 10 billion yen plus the 200 interest payment, and your counterparty will receive 106 million, or in yen, whatever they want, whatever the prevailing exchange rate is at time t equals 5. So why would a company engage in such a contract? Well, because they may need yen to pay off something, right? So they may have yen liability, which means they are preferred to receive in yen. Okay. So therefore, what it has done with the swap contract, it has converted its US liability, thereby transforming yen liability into a dollar liability. Sure. Yes. Yeah. Okay. So they had they had yen liability, they pay it off, and then they convert it to a dollar liability. All right, so pricing. How do you price swaps in this class? So we're not going to assume there's any chance of default, okay? And we're also not going to model exchange rates. When we price each of these bonds, we're just going to assume that exchange rates are stable, okay? Unless something changes, unless something fundamental value, unless something changes in between, and then we can recalculate the present value of both legs. So take for this example again, 5-year yen per dollar swap, 2%, 6% again, and then E starts out at 100. So as I mentioned earlier, both sides of the legs are equal in value, and so the MPV of the swap is 0. Or in other words, PV yen leg equals PV dollar leg, right? So PV. Now to make things so it's not interesting here, right? At contract origination, the valuation is boring, right? Because we're just talking about present value of just bonds, assuming interest rates don't change and exchange rates don't change. And from now until end of 5 years, nothing happens, right? And so they must be equal in value. But over time, maybe in this case, in this example, I'm going to assume that after 1 year, the exchange rate changes and the interest rate changes. So here I'm going to assume that after 1 year, E is now 90. And the yield curve, the term structure of interest rates, is now different for each country. So R is 1% and is 1% for Japan and 5% for US dollar, or for the United States. So my question is, what is the payment at the end of 1 year? First, so that's simple, right? Because we haven't considered anything changing at the end of, beforehand. So what you would receive is just 2% times 10 billion yen, which is equal to 200 million yen. And you would pay out 6% on 100 million USD, which is equal to 6 million USD. So let me write JPY to be consistent here. So that's the end of 1 year. So interest rates haven't changed. Exchange rate hasn't changed. And so still the same. So if you want to convert this to yen, it's possible. That's fine too. Nothing has changed. E times 6 million. Yeah. Yeah. Okay. But after 1 year, 2% becomes 1%, 6% becomes 5%, and 100 yen per dollar becomes 90. So the value of each leg has now changed because we're assuming that whatever changed after 1 year persists all the way to time year 5. So if we want to calculate the dollar leg, we just look at the next the remaining 4 years of cash flow. So let me do that. Oops. That is just equal to 6 divided by 1.05 plus 1, 2, 3, 4, 6. Then 106. I didn't need to do the parentheses. But anyways, equals 103.55 million dollars. USD. Create. And enlarge this. There. All right, so pay attention. What's different? The 6 hasn't changed, right? Remember, at contract initiation, it's still 6% coupon. The coupon rate hasn't changed, right? The interest rate payments has not changed. It is still 6 every year. What has changed is the discount rate, right? The discount rate is lower, right? And so therefore the value is more than 100 million. Right? On more than 100 million. For the yen, do the same. So let me do that quickly. Let's modify this. It is not 6, it's 200. Make it 200, 200. And final is 10, 10, 200. And it's a discount rate of 1%. And the value is 10,390 million JPY. Great. So again, notice the 200 numerator is still determined based on the 2% prevailing interest rate at time 0. That was the rule. Those are the rules or the agreement at contract initiation. But what has changed is the economic environment. The discount rates are different. And so you must discount each of these cash flows by the different interest rates now. And you notice that each leg actually becomes more valuable, right? More than one because the discount rate is lower, right? 103 million for US dollars instead of 100, and it's 10 billion yen, 10 billion and 390 million Japanese yen instead of 10 billion. The value of the swap from the perspective of the long leg, let's just do that. That's 10 billion 300 million JPY minus, let's do 90 times 103.55 million USD, right? So this is yen, JPY, and this is an exchange rate of 90 JPY per 1 US dollar, right? That. So now you see where the exchange rate creates problems now, right? For the opposing leg. So the difference you should get is 1.071 billion JPY, I believe. And it's actually, it's actually helping me, right? The Japanese yen has increased in value, and I'm assuming the Japanese leg, the exchange rate persists, still 90 all the way to the next 4 years. Again, unrealistic, I understand, but for our class, let's just assume that whenever I say exchange rate changes, it changes and it stays the same until maturity. In which case, the value of the swap is calculated from the perspective of the dollar leg, of course, is 1.071 because I'm taking the difference in cash flows, right? It's just the bond portfolio value essentially after currency conversion. Yeah, that's it. All right. I hope that's clear, right? Because all I've done is just use DCF, present value, bond value, right? Just the portfolio of bonds, and just tweaked discount rates here and there, and then changed the exchange rate, and therefore my swap value changed. Again, the assumption is whatever change in interest rates or exchange rate is going to change, over after the 1 year, and then it's going to persist all the way to maturity. That's the assumption here. Okay, yeah, so I've already showed this, so let me summarize in just 1 minute, and then call it a night. So swaps super easy, right? Super easy to so yeah, I already did this. So super easy to calculate. I probably shouldn't have had that all out, but anyways, super easy to calculate. In this class, I'm not going to make you model the time variation of interest rates between two countries. I'm not asking you to model the time variation of exchange rates. I'm assuming that if there is a change in interest rate or interest rate, it's going to change and then persist forever. So it's very easy to recalculate the value of the swap after something has changed, right? The key idea that you should take away is, I mean, the key fundamental idea just means, no arbitrage, right? At contract initiation, both parties agree to engage in a swap because the value of each leg is the same, and therefore nothing exchanges at time zero. Okay, it only changes because macroeconomic environment has changed. In which case, one leg could be more valuable than the other, and the spread of the difference in present value is the value of the swap. Okay, it depends on for which leg dominates, right? Okay, so I realize I have some questions here. I'll just go over it next week. So if you have some time, look it over, and then I'll go over the solutions in class next week. All right, so next week I believe I'll talk about forward contracts, and maybe touch a little bit on options, and then that's it. And then we'll talk about something new afterwards. Okay, see you guys next week.